2025, new year, new administration, new hopes and dreams. All right, let's see it. This is the real story with Adam and Sherry. I'm Adam Hamalian,
And I'm Sherry Hutchens.
and we are really excited to start season two of the real story. We never thought it would get this far, but here we are. And we are actually not only are we starting a second season, we are having our first repeat guest join us today, Arlo Zoerner of CrossCountry Mortgage. Hi, Arlo. Thanks for
Yay.
joining us.
Good afternoon. Thank you guys for having me.
Of course. And one of the reasons why we wanted to start with Arlo is that as we look at a new year, a lot of people made conversations over their holiday dinner tables. Is this the year that we're going to try and buy a house, or we're going to move, or we're going to sell? And of course, funding is a big part about that, whether you're buying for a first time or you're trying to buy without selling and all of that. So, who better than to have our favorite lender come and join us and share some of his wisdom? So, how's that for a tee up for 2025?
Made the introduction pretty good. Thank you guys for having me. It's great to come back. And yeah, looking forward to the year ahead. There's always some unknowns when you start the new year, but just put one foot in front of the other and see how our real estate market responds this year.
Yeah. So, before we look forward, kind of as a recap for 2024, like was it a good business year for you or for mortgage in general, or what's a snapshot of last year look like for you?
Yeah, 2024 turned out to be a good year. We kind of have to just forget about the years of the pandemic because those were somewhat artificial in whatever way you'd want to say it. But yeah, 2024 was a great year. Had lots of fun helping people and solving. It was nice having a couple years, like we're in a tough climate with the higher rate climate that we've been in, but it was nice not being in the first 3, 6, 9, 12 months of that climate. We've been in this climate for actually close to 3 years now. I mean, that's on a 3-year anniversary here in the next few months from when they
Yep.
started rate hikes. And so the tools and what to use were tools that I had used a little bit more in the last couple of years. I think that just helped navigate the markets and understand what consumers needed to help them reach their goals.
Yeah. Yeah, I think that we felt that same kind of time frame as it's affected inventory. I think, people have been stuck in place around having higher rate or lower rates on their current house. And not only are they, if they want to upsize, not only are they buying a bigger house, but the cost of the mortgage has been high. So people are just kind of hanging out where they are. So,
Yeah.
and probably no refi business for you either, I imagine.
Yeah, it's a funny subject you bring up. There was quite a bit to be had for a 30-day period, right around August and September, or specifically like right around the month of September. Interest mortgage rates fell 1% over about 30 to 60 days, which is a very big drop. And so interest rates reached the low sixes and actually even touched the very top of the fives for a brief period. That was all before the Federal Reserve cut their interest rates for the first time on September 18th. That was the first rate drop in over 3 years.
Yep.
And what was totally unexpected was the Fed cut rates 3 times in the last 90 days of the year. They cut rates 3 times for 1%, but mortgage rates had the exact opposite response because of some
Yeah.
other factors and other market things. And nobody saw that coming. Everybody thought we would end the year in a better rate spot. And so transparently, it felt like a bit of a slap in the face for
Yeah.
consumers, realtors, and lenders. Digesting those last 90 days, like, well, I thought we're out of the woods and we were getting ready to look around the corner and hold on a second. No, mortgages are going from 6 back to 7 in a very short period of time. So always lots going on there.
That was a surprise. Did not expect that.
It was on no more trade off.
No.
Yeah. I mean, I think the thing that's still kind of hard to get our heads around as we think about rates is historically, this is really average. I mean, I know that some people are saying historically they're low, but I mean, certainly compared to the late 70s, when interest rates were 13, 17%, it's low to that. But it's just because they were giving away free money during the pandemic that a 6, 7% interest rate is feeling onerous, and in reality, it's not a bad rate historically.
I think the one The challenge though, and within that is, and I've alluded to this in some other material that I've put out, is I just, correct me if I'm wrong, but it's like one of the 6 to 7 is not a bad rate. Historically, most people would definitely sign on the dotted line and be very happy to land at 6.5 to 7, as an example. The challenge is where we are with prices.
Yeah.
When you spend a decade around 4 to 5, and then you spend a couple years after at 2.5 to 3, it's those rates being 2.5 to 3 for a couple of years absolutely helped the market evolve and appreciate to these levels.
Yeah.
Yeah.
So it's just carrying today's rates with prices that escalated off of 2.5 to 3% rates. It just has made like a major affordability challenge. So no, we're not in a bad spot, but where values rose to off of the previous 10, 12, 14 years has created this quote unquote normal climate for rates, or more a reasonable climate for rates, to be pretty challenging in a lot of situations.
When I got into the business in 2001, rates were about in this area, 6-7%. But a luxury home in Lafayette was $600,000 or $700,000 or 800, and now it's 2 and 3 and up. At the same interest rate. It's the price.
And wages have grown some, and like inflation has come along some. But we also went through nearly 2 decades with almost no inflation.
Yeah.
So we had like prices very stable for a long period of time.
Yeah.
Real estate saw a lot of great growth, capped off by those pandemic years. And then to just have rates go from 3 to 7, because that's essentially what happened 3 years ago. Mortgage rates went from 3 to 7 in about 3 to 6 months.
Yeah.
We watched it. Our business came to a stop.
Yeah.
March 2022 or something.
It was, yeah,
around there.
Spring of 22 is when that first rate. And they kept talking like, no, there's no inflation. It's shadow inflation, which I forget at this point what the definition of shadow inflation was, but they were actually trying to say like, no, we don't have any inflationary problems. And then come to find out that it reached 8-9%. That's as it's measured. Maybe it was more than that, but it reached 9% during some of those worst periods. So yeah, a couple of decades with no inflation and low rates and values rising from that, and now having rates go from 3 to 7, creating some challenges in the market. Sure.
Yeah, tough times.
Yeah. So with all that, like digging up the last few years, actually, I'll say one more thing about the last few years. One of the things that we were just doing some year-end numbers and just looking at the 10 cities that Sherry and I primarily work, and we know you work in a much bigger geography. So if you all are listening about lenders, this is not Arlo's market. He does much more than we do. But the 10 cities, so Alamo, I'm going to try and do it in alphabetical order. Alamo, Clayton, Concord, Danville, Lafayette, Martinez, Moraga, Orinda, Pleasant Hill, and Walnut Creek.
Good job.
So those are the 10 cities that we normally work. We do work outside of that, but those are the ones that we track, single family homes. And we were looking at number of single family homes that sold each year over the last 10 years that kind of get some market trends. And the peak was 2021, the number of units sold, and it was, I think, just over 5,000. But the 10-year average is about 4,000 homes per year. And 2023 and 2024 were both less than 3,000 homes. So about a 25% below the 5 and 10-year average. And there just aren't that many homes out there. So you'd think with that lack of inventory, we'd see skyrocketing. But we've seen this balance because buyers are fewer, and the ones that are out there are more reticent to spend their money at 7%. And so we're kind of seeing the tale of two houses. If it's a really nicely well done house, a buyer is more willing to write on it and maybe even write over. And if it's a house that's got some sort of structural defect, when I say structural, what do you call it, Sherry? Incurable defect.
Incurable defect. Yes.
Yeah. So power lines in the backyard, backing to Ignacio Valley Road. No garage. Some of these things. Sometimes the garage can be fixed, but some of the things you can't fix, people are like, I'm sure I want to spend that amount of money on that house. I'll just wait. So you have some houses selling in 10 days and some taking 45 to 60 days. Yep. And very few things in between, obviously, depending on how they're priced. So I think that kind of supports the narrative that we've been talking about as far as home prices actually are stable, even though there's higher interest rates, because there just isn't inventory. So,
And
yeah,
prices are slightly up, not just stable, but slightly up over
yeah.
last year for the 10-year, those 10 cities. If we look at them individually, I would expect some of those areas to be slightly under.
Yeah. And I think if we looked at condos, we'd see a different narrative also. The condo
Absolutely.
market and I don't know if we're going to dig into that part with Arlo here, but lending on HOAs on properties that have HOAs has been its own little mini narrative. Uh, should we transition to looking forward now? What
Yes.
I know that we asked you to do a little research on what you anticipate what's going to happen mortgage wise in 2025, and I know that we're not pinning you down to this. This is just you're based on what you've been looking at.
So, mortgage wise, projections have been revised upward, unfortunately, a little bit in the last couple of months once the new presidential, Trump won the presidency. And so there's going to be a new administration. And some of his policies there's, whether it's fear, speculation, or it's valid, we've yet to see. But some of his policies look like they're going to potentially or likely to create more inflation. And so that has caused the companies that have forecasted where rates will go to be a little bit more conservative with what they see happening this year.
Mm.
The end of 2025, we were, I think, supposed to at one point land around 5.5 to 5.75%. I was
Yeah.
going to be the target of where we would get to in the next 12 months. And for the most part, all the major outlets, they revised those forecasts up by about 0.5%. So we're starting, for the most part, what we're seeing is projections between 6 and 6.25. More specifically, this kind of consensus is looks like it's about 6.2% is where we're supposed to end the year.
All right.
There's bumps in the road, right? We may end up a little better than that. We could end up a little worse than that, and it's not a straight line. So think of mortgage rates. It comes in a series of waves where there's peaks and valleys along the way.
Mhm.
But general consensus right now, we start the year on a national level, kind of a nationally reported average at 6.7%.
Okay.
Mm.
Projections are to end the year around 6.2%. So some progress, but less progress than what was originally expected.
Yeah.
Well, that doesn't sound too unreasonable, though. I mean, I think that, like we were saying earlier, being able to have a 6.2 mortgage rate would be historically very digestible.
Yeah.
And if it looks better than it is now, that's in the right direction. But yeah, I remember when I first heard the quote, this is probably 6 months ago, they were projecting how low it was going to go. And I'm like, that's never happening. I don't know whether I was being a pessimist or I was just able to crystal ball, but it's like, yeah, there's a certain amount of economists that are out there that want to, get people's hopes up, right? Consumer confidence. They're really trying to booster that, and I wasn't buying it. But maybe that's just my skepticism.
One thing that people who are listening to the podcast can latch onto, though, that I always try to share when I'm consulting with new buyers or people I've already helped and they're moving again. Just keep in mind that most people in present day are still choosing a fixed rate mortgage. So that just means it's normally a 30-year term or a 30-year loan.
Yeah.
You have one interest rate and one payment throughout the whole term. So the council, that I've done this since 2002. So whether it's good or bad, it's been a little more than 20 years. And the council that I always try to remind the buyers of is, I promise you're never going to wake up when you have a 6.5% loan. You're never going to wake up and go, geez, I'd really like to have one at 7.5 or 8. So
Mhm.
where you're starting in this climate probably will be the highest rate and carrying cost that you ever have. And that over whether it's 1 year, 3 years, 5 years, 7 years, but home ownership is a long journey. And there will be some strike points where you can reduce the rate.
Yeah.
So it's still actually, our market's a little depressed, but on the buying side, I think if we had continued to see double-digit appreciation for the last couple of years, you'd be paying so much for a home compared to where we are.
Yeah.
And it's actually, these higher rates are creating an opportunity for buyers to where they can stomach the short term, that's 1 or 2 or 3 years,
Yeah.
they'll strike points and they'll roll their rate down 0.5% or 1% through refinancing. And doing that a couple times over hopefully gets them into the 4.5 to 5.5 range in the next 1, 3, 5 years. So you only lock in the sales price once, but you have the whole time you own the property to be able to make some improvements on it. I think that's important for people to remember right now.
Yeah. Well, I heard somebody, I don't know how common this phrase is. I heard somebody say, date the rate and marry the house. Like, find the right place that's going to work for you. Because the rate is what it is. It's going to be fluctuating, and refinancing is, can be an option. We never want to guarantee, right? Because all sorts of different things can happen in the future. But that kind of brings me into one of the lenses that I personally have to look at. I'm a parent of a young adult who's out on her own. Well, two young adults. One of them is out on their own. The other one's still in school. Uh, and if you think about what advice would you give to your own adult child, is probably the truest advice you would give to anybody, right? This is your little nest egg. Your little whatever the phrase is I'm looking for there. But I'm just kind of curious, if you were going to give advice to one of your kids and they were, young adults, they were in a position to settle down, what would you give them about buying and about loan products going into this new year?
Yeah, great question. For those listening, I do have 5-year-old, 9-year-old daughters, so I'll give an honest answer here. What I would also share with my own two girls. I think the big key is just to not get too caught up in the moment and the news, and just to remember that real estate is truly an excellent long-term investment, and it's also a hedge against inflation. And just generally speaking, as soon as you can afford to buy a home because you're on solid financial footing, you should purchase a home as soon as you're able to.
Yeah.
It's really difficult to have this perfect timing in the market, but what financial planners tend to preach is it's time in the market as opposed to trying to time the market.
Yep, I've heard that.
So one of the things that's common right now is people may say, well, I'm not going to buy today because I'm going to wait for mortgage rates to come down. I mean, yeah, everyone wants to have the lowest possible rate, but with lower rates, probably going to have higher home prices.
Yes.
But to answer your first part of your question, my own children, I would tell them that, and just whether it's children and other people who are considering becoming homeowners, when you're on the right, strong financial footing and home ownership is going to be sustainable, that's the time to get started with real estate.
And you think that 2025 is as good of any year to go ahead and make that step if you've got the financial wherewithal to do that?
Yeah, I mean, there's still when we looked at like roughly a dozen different organizations and companies, such as Zillow, Wells Fargo, National Association of Realtors, we took a look at about a dozen of them, and the consensus was somewhere between 2 and 5% of appreciation. I do want to try to just footnote it. That's more of a national level, so I don't know if we will underperform or outperform that locally, but we're targeting an appreciation still this year. I'm always personally I like looking at 10-year, 20-year, and 100-year histories. Real
Yep.
estate has a great 100-year track record of appreciating. And so if appreciation is still taking place in this quote unquote higher rate environment, this more difficult rate environment, I think it's still a great time to get started if you're in the right financial place to be able to do so. And again, you lock in your price once, but over the next 1, 3, 5, 7 years, that opportunity to reduce carrying costs, home prices will probably be higher during those periods when rates come down.
Sure. Did you have any questions? I realize I dominate all of the conversations we have. We were on a phone call earlier today. I'm doing it again now, Sherry, while you're thinking about what you want to ask. But we were on a phone call with a referral agent, and I talked for like 10 minutes straight. And I finally realized that I had been sucking all the oxygen out of the space. And I said, actually, even though Sherry has been allowing me to do all the talking, she really is the backbone to our partnership. She has twice my years of experience, and she's just being polite while the junior hire can't stop. So, Sherry, any
But
thoughts?
I'm not being polite. You had a wonderful run going on the phone this morning. So much so, Arlo, that when he paused and asked me if I had any questions, I said, no, I'm just completely fascinated by what you just said, and I want to hire you. So I don't have to
Actually,
have every word. I don't have to get every word in.
yeah, no, I
When I
think
have something to say, you will absolutely know it.
all right. I actually near the end when we were trying to sell ourselves, I gave all of our uh, credentials, and then I realized, oh, should I said to Sherry, should I tell her about the podcast? And she goes, "You have a podcast?" So, yeah, it's
We were
all
trying to sell ourselves because she was going to refer a $1.2 million seller to us, which she ended up doing. So, but you always have that conversation with the referral agent, and you have, it's a little more than an elevator speech to try and get them to say these people can do the job.
yeah.
And here's the phone number of the seller.
So we were excelling on the podcast. Um, you were mentioning something before we were getting started about maybe some alternative options like a buy down, and maybe you could explain that to us. So this is where somebody is able to reduce their interest rate either for a short period of time or for the duration by paying points or something like that. So please, everybody ignore me. Now listen to Arlo make the real explanation.
Yeah. For anyone who's considering a home purchase this year, because mortgage rates have remained a little bit more elevated than what we expected, you really should look at or consider using a temporary buy down. I think is the right tool right now. You should look at and consider a temporary buy down. One specifically is called a 2-1 buy down. And so we talked a little earlier about interest rates starting the year at 6.7%. What a 2-1 buy down does is it gives you a 2% discount on the rate for the first year. And then it gives you a 1% discount in the interest rate for the second year. So you would get to spend your first 1 year of owning at 4.7%. And that would be the rate on your loan, and that's what payments would go off of. So you'd be a pretty big discount on the rate of payment. You'd spend the first year at 4.7. You'd spend your next year at 5.7. And if you just take a quick pull this off to the side, that means you're averaging 5.2% over the first 2 years of ownership.
Okay.
So this is just building a bridge to get into a lower interest rate environment. And with our market, with some of the challenges we have in the market, negotiating buy downs, this is something you can't really do, and it's highly competitive. You're always facing 5 to 10 offers, or it's like lots of multiple offers, a super competitive situation. But in our climate, buy downs could definitely be a tool to help you reduce payments over the next few years. And our market is, generally speaking, you can probably find ways to do those negotiations. So that's a great tool that I was using a lot right in the beginning. I feel like they faded out a little bit, but they're really relevant right now. The combination of where rates are and what market conditions are, they can help it make more palatable for every buyer to get started.
And do you pay it by paying points? Is that what you do? By point
Yeah,
pay
so
points?
the buy down is a seller concession. So that means it's a credit that you negotiate from the seller. It actually can't come from the buyer's own funds. It needs to come from the seller's funds.
Okay.
Oh, interesting.
Yeah. And the 2-1 buy down is going to run about 2%. You're going to end up needing a credit that's right around 2% of the loan amount, not of the sales price.
Okay.
So $1 million house, if someone is putting down 20%, it's 200 grand. They're getting an $800,000 loan, and your 2% credit's working off loan amount, not sales price.
So
I've seen them advertised or agents commenting on them in confidential remarks, seller willing to do a buy down, please inquire. They're not very often, but I see them occasionally.
Yeah,
so
go ahead.
So just to clarify, so on the payment, your payment for the first year will be based on that lower interest rate. So you're making a smaller payment?
Exactly. Yeah, to clarify it out too, it's actually not an adjustable rate mortgage. So it's not like many moons ago, there was a lot of risky products with big changes to monthly payment and big changes to interest rates. And there was also a lot of unknowns. How far will this rate go up? And what are the limits of what can adjust and change? This is actually a product that's being used on a 30-year fixed rate loan. So just picture that you obtain a 30-year fixed rate loan at 6.7 as an example. That's the national average of where the year started. You're getting a 30-year fixed rate loan at 6.7. you're spending your first year with a 2% discount. So your first year, you're paying 4.7 rate, and the payment's based on 4.7. In year number two, you're going up to 5.7. The 1% discount you get that second year. And so that's what the rate will be, and the payment will be based off of. If rates do not come down and you never refinance, then you'd spend the remainder of years 3 through 30 at that 6.7% rate. So it's actually not considered an adjustable because there's a fixed underlying guaranteed rate, and you negotiate the seller to contribute this concession, and that causes a reduction in rate for the 2% of a reduction in year one and 1% of a reduction in year two. And again, it's just a great tool to build a bridge to get through the next couple of years and look for a time when you can lock in a lower rate when we relax a little bit.
And so just further clarification, you're approving buyers on the full 6.7. So they can afford today the highest amount that they won't be paying for a couple of years. All right, that's good. Because I knew that they were not dubious like what we were seeing before, but I felt like I needed to tease out those questions just so everybody could hear that.
So it's an incentive to get them to jump now instead of wait.
And it also, from a seller's perspective, potentially, so let's, like in the example you gave, 2% of a $800,000 loan is 16,000. So if the seller if the buyer and the seller can negotiate a price that the seller is willing to kick in that 16,000, it should easily be covered by the reduced price of the reduced payments for the first couple of years. So yeah, so that's all a matter of what you can negotiate. And a seller, and depends on the property, right? If some seller's been on the market for 2 months, they're ready to sell, they might be willing to consider anything.
Yeah, if you catch the property where it just came on yesterday, there's 30 people through there this weekend, and they look at offers next Tuesday. That's probably not a situation where
right. Yeah.
But that's just makes up a segment of the market, and there's a little bit of a larger segment now where that's not happening. One other cliff note, it's not too far into the weeds, but one other cliff note is this reduced payment over 2 years. Most consumers' wages rise a little bit per year.
Yep.
A lot of people, teachers, police, fire, union workers, they have locked in and guaranteed raises, right? Maybe they're going to go up 2% a year as an example, or 3%. A lot of times what I see is the consumer starts the buy down period with this 2% reduction in rate. So they get the reduced payment. Then after 12 months, they move up 1%. But actually, this is a tool that gives their wages time to move up a little bit. And sometimes what I'm seeing is that the mortgage is going to go from 4.7 to 5.7 as an example after 1 year, but they know that their 3% increase in salary is going to result in a $450 or a $550 a month, as an example, increase in their monthly income. So they may actually be able to just keep pace where their wages rise along with the mortgage, but that mortgage only steps twice, 4.7 to 5.7, and then 6.7 is the final level. So giving some time for interest rates to come down, but also giving consumers time for their wages to come up. They may actually not feel like a net increase of where their payment is because of some wage increase that will take place.
Arlo, have adjustable rate mortgages completely gone away? Because it used to be that you could do a 5-1 or a 10-1, and the interest rate was, 30 or 40% less than a conventional, and everybody would just refi into a 30-year after they got to the end of their term.
Yeah.
But have they gone by the wayside because of what happened with the recession?
It's not because of what's happened with the recession, but they have for the most part gone by the wayside. The challenge is we have what's called an inverted yield curve right now. So one of the things that's been really unique about the last couple of years is, has anybody noticed that on like idle cash, you were able to get close to 5% interest on just overnight idle cash? So look at the history on this. We went through the pandemic. I don't know. I mean, it wasn't quite zero, but like the best money markets and savings rates when the government had everything so low, you definitely could not make more than 0.5% to 1% in even the top tier money markets and high yield savings and whatnot. When the government increased rates, I think maybe 10 consecutive times over a very short period of time. What happened, what an inverted yield curve means is short-term interest rates are actually higher than long-term interest rates.
Okay.
And so that pairs in with adjustables. And that's the challenge with adjustables is that short-term interest rates are actually worse than long-term interest rates.
Wow.
And a 30-year fixed mortgage is tied to a 30-year bond. The rate on that is actually lower than the rate on, say, a 2-year CD or a 5-year bond or CD. So they haven't gone away. They're just not relevant right now because of this
Right.
inverted yield curve, because of the interest rate environment.
Okay.
That will revert back out. There'll come a time where we get back to more normal. Normally, the longer you have the money tied up, the more they're willing to pay you.
Yeah.
But right now, that's not the case. So they will come back, and you'll see a spread come back where they make sense. But right now, most of the time when I look, I see adjustables within 0.25% of a fixed rate loan. Sometimes they're actually priced worse than a fixed rate loan.
I've seen them higher.
Yeah, they're often higher. But again,
Yeah.
that's because of the inverted yield curve and how high short-term rates are and how low long-term rates are.
Interesting.
Fascinating. Yeah.
You have a hard job trying to keep up with all of the different numbers and indices and products and then you throw in the government requirements.
Never a dull moment.
Never a dull moment.
Every industry, like I appreciate you saying that about our industry, but my goodness, I mean, look at your last 12 months, right? Like hear about this tiny thing called a settlement, which completely was supposed to change the whole way real estate has ever been bought and sold in the last 100 years.
Yeah.
The funny thing is, it hasn't changed much, really, when it comes right down to it. I mean,
Well,
everybody fretted about it for months. It's all anybody talked about, and now it's kind of business as usual with one small change.
well, I actually think that it was a well-needed change. The more we get past it, the more it's like, why wasn't it always like this? It's more complex in this, but it's when you explain it as, well, the settlement basically says, buyer, you hire your agent and you decide how much you agree upon a fee. Seller, you hire your agent and you decide on what your fee is going to be. You're like, yeah, why wasn't it always like that? Right. And obviously it comes into some financing and some other stuff like that. But at its core, it's like, yeah, of course, everybody should get to hire their agent and pay them whatever you negotiate. It's not really that complicated. Yeah, I was as Sherry was just complimenting you on staying up on all this business. We were talking about you earlier, and it absolutely was 100% compliment about the fact that you sent over all the show notes and things that we were going to talk about, and we're very well organized, and you really wanted to make sure that we had all our bases covered, and you knew what you were going to say, so you could be prepared for it.
Yeah.
And I said, well, have you not met Arlo? That's exactly who he is. He's the guy who's prepared. He's the guy who goes to the details.
Yeah.
And like, this is why we love sending our clients to you, as opposed to me, who I just want to turn the camera on and let's just start talking for 45 minutes and whatever comes out, comes out. It's like, have you not met me? That's Adam. Like, like but I can only wing it because I've done enough, business and research. But I love the fact that you pay attention to the details in a way that you're aware of what your clients and our clients that we refer to you are able to what's available to them, what they need to do, and just even we were talking earlier about regular contact and communication with all the parties involved. So I really appreciate the hard work that you did for today's podcast, but just in general for your clients.
Yes.
So just last couple thoughts. So overall feeling about 2025, you think it's going to be a year that real estate and mortgage lenders are going to excel, or is it we're going to work hard to earn our living, or it's going to come, it's just going to come to a crashing halt and we're all going to be homeless?
A good question. Definitely not on the last part, but expect a mixture of the first two. We're not completely out of the woods. But again, every market has challenges. Ours clearly does. But also, we've had a few years to prepare for these conditions. And 2022 was a tough year where life had been one way for so long. I mean, how it is for loan agents and realtors, I don't really view that as actually quote unquote important.
Yeah,
It's more of like what it's like for the consumers.
absolutely.
And so when you put yourself in the consumer shoes, the real estate world had kind of been how it was, and seeing that first big change in interest rates in literally 20 plus years, when they went from 3 to 7, there was a ton to digest. Nobody really was ready and equipped. But we all, consumers and all the professionals, have really have acclimated to the new climate. So 25 will be a good year. 25 will be a year where we um, continue to, yes, wait for lower rates, but also start to accept more of the new normal. And I think it'll be a good year for housing, for professionals and for the consumers.
Yeah.
People always need a place to live and
Always,
you can get used to anything.
Yeah.
Two of my favorite.
all the doom and gloom you want in the world, but the world continues to spin. As I said in something else I published recently, the world continues to spin. People need a place to live, as you said, and people covet real estate right now.
Yeah.
You know, if you look back at the Great Collapse, that wasn't a time where people coveted real estate, with all the foreclosure crisis and everything that was going on. But even through this higher, quote unquote, higher rate environment, real estate's absolutely coveted in the public's eyes. People are very proud of the real estate they own. They see it as a multi-purpose investment, or it's something they can live in and have it be an investment and appreciated asset for them.
Yeah.
I don't see that changing for not the next 12 months.
I don't either. No.
I realize, I know I just said we were going to sum up, but I kept meaning to ask you about CrossCountry Mortgage. I saw something that you guys are one of the largest lenders in the nation. Is that true?
It is, yeah. We've had a really big run of growth. I've been a loan agent since 2002. I've been with CrossCountry Mortgage for about 4.5 years now. And there's a few others that are really close, but yeah, we actually are holding the largest retail lender. We're holding the spot for largest retail lender in the United States. We weren't quite as big out on the West Coast. We've grown a lot in the West Coast during the last couple of years. But yeah, just by a smidgen, we're holding that spot. And the owner has an amazing head on his shoulders. Great trajectory for the company, and our brand recognition now is definitely all over California.
Yeah. Well, I know that
Nice.
you had been with another company previously and made a pit stop someplace else before landing at CrossCountry Mortgage. And it seems like your systems at CrossCountry have really settled in and been easy to work with. So I hope that that's been true for you. A little, job satisfaction. Obviously, taking care of our clients is the first most, but we both operate under somebody else's system that hopefully gives us the tools we need and the life-giving space to do the thing that we do. Any final thoughts before we sign off for our first episode in season 2?
No, thank you guys for having me. And for those of you who are listening to the podcast, this part was not planned, but Sherry and Adam are just two of the finest professionals. I've done this for 22 years, all local here in the Bay Area. I can promise you, if you're listening to this podcast, you have the opportunity to interact with Sherry and Adam, that they will, no question, put your best interest first, leave it all on the table representing you. And you absolutely should take advantage of the opportunity to have them be a part of your real estate. Those are my thoughts.
Well,
Thank you,
thank you,
Arlo.
Arlo. That's
Appreciate that.
very kind. Well, we'll probably have you on mid-year for a mid-year update and see how all your predictions went wrong.
So like, they're mine first. Sounds good.
Because the business will be way better than any of us imagined. But yeah, if you have any lending needs, just to ask questions, Arlo will be happy to be your resource. Whether you are buying or refinancing immediately or just need to get your ducks in a row, sometimes helping people get their FICO scores up is part of the journey, and he can help you with that. So, Sherry, any
We'll
last thoughts?
contact information in the show notes.
Yes, contact information in the show notes. Sherry, anything else?
No, that's it. We're going to have a
All right.
great 2025.
All right. If you like this episode in our podcast, be sure to like and subscribe and refer us to your friends and family. As for that, let's all look forward to a great 2025. Bye, everybody.
Bye-bye.
Thanks again.
Mhm.